Hello everyone, welcome back to my YouTube channel. I am Saundarya V, currently studying MBA at Sri Venkateshwara College of Engineering. Today I am going to present the topic on techniques of capital budgeting. Let's move on to the introduction. What is capital budgeting? Capital budgeting is the process of evaluating and selecting long-term investment projects or capital expenditure. It involves analyzing the potential profitability of projects to determine which one are worth pursuing and allocating financial resources accordingly. Capital budgeting decisions are crucial for businesses as they involve significant financial commitment and can impact the company's future growth and profitability. Next, the importance of capital budgeting in financial planning. Efficient allocation of resources. Businesses have limited capital, and capital budgeting ensures that those resources are directed towards the investment with the highest potential return and making informed decisions. By analyzing the future cash flow and potential risk, capital budgeting technique provide a data-driven approach to in the investment decisions. Long-term impact. Capital budgeting technique allows for a comprehensive assessment of the long-term financial implications of potential investment, which helps the businesses to avoid the mistake and ensure that the financial long term financial is healthy. Risk management. Capital budgeting incorporates risk analysis, enabling businesses to identify and evaluate the potential risks associated with the investment. Improved communication. The capital budgeting process often involves collaboration between different departments within the organization. So effective communication is required so that the necessary information is uh, transferred within the different department within the organization. And performance measurement. Capital budgeting ensures a baseline for evaluating the performance of investment after they have been implemented. By comparing the result of the organization can improve the budgeting cycle in future. Techniques of capital budgeting. It is divided into traditional method and modern method. Traditional method is classified into two types: payback period method and accounting rate of return. And modern method is classified into net present value method, profitability index method, internal rate of return method, terminal value method, discounted payback period method. So in traditional method, first payback period method. The payback period method is the amount of time it takes to recover the cost of an investment. So it is simplest and most widely used method in the organization. A firm is always interested in knowing the amount of time to recover its investment. So it is based on the concept of cash flow and is non-discounting techniques. The payback period is calculated by using the following formula. Payback period is equal to initial investment divided by annual cash inflow. Accounting rate of return. Accounting rate of return is the average net income an asset is expected to generate divided by its average capital cost expressed as an annual percentage. So formula is equal to ARR is equal to average annual profit divided by average investment. So there are some advantages. It is simple and easy to calculate. And ARR measures the benefit in percentage, which makes it easier to compare with other projects. And accounting rate of return method is helpful to distinguish between the projects where the timings of saving is approximately the same. And there are some disadvantages. ARR ignores the time value of money, and this method is based on accounting profits rather than the cash flow. In order to maximize the wealth of shareholders, cash flow should be taken for calculations. Next, modern method. In that first one, net present value. It is a method that primarily used for financial analysis in determining the feasibility of investment in a project or a business. It is the present value of future cash flows compared with the initial investment. Formula for calculating net present value. Net present value is equal to RT divided by 1 plus I into T, where T is represented as time of the cash flow, I represent discount rate, and RT represent net cash flow. Profitability index. The profitability index method measures the ratios between the present value of future cash flow and the initial investment. The index is the useful tool for ranking investment projects and showing the value created per unit of investment. The profitability index is also known as profit investment ratio or the value investment ratio. Formula for calculating the profitability index is profitability index is equal to net present value plus initial investment divided by initial investment. Third, internal rate of return method. IRR is a metric used in financial analysis to estimate the profitability of potential investment. Internal rate of return method is a discount rate that makes the net present value of all cash flows equal to zero in the discounted cash flow analysis. Formula for calculating net internal rate of return is equal to NPV summation T is equal to 1 CT divided by 1 plus IRR into T minus CO, where CT is equal to net cash inflow during period T and C0 is equal to total initial investment cost, IRR internal rate of return, and T represents the number of time period. Terminal value. It is the value of an asset, business or project beyond the forecasted period when future cash flows can be estimated. Terminal value assumes a business will grow at a set growth rate forever after the forecast period. Terminal value often compromises a large percentage of the total assessed value. Last, discounted payback period. The discounted payback period is the capital budgeting procedure used to determine the profitability of a project. A discounted payback period gives the number of years it takes to break even from undertaking the initial expenditure. By discounting future cash flows and recognizing the time value of money, the metric is used to evaluate the feasibility and profitability of a given project. Conclusion. In conclusion, effective capital budgeting techniques are crucial for informed decision making in financial management. Methods such as net present value, internal rate of return, payback period offer valuable insight to the profitability and risk of potential investment. Net present value provides a clear measure of value addition by discounting future cash flows, while IRR offers a rate of return perspective that facilitates com- com- comparison with required rate. The payback period, though simple, helps to assess the liquidity by determining how quickly an investment can recoup its initial cost. Thank you.